Hello and welcome to our look at moving average crossover systems. In front of you I have a chart of the dollar Swiss on the 30-minute time frame, but quite frankly, this works in all financial markets. This is one of the oldest ways to trade financial instruments and as a result one of the most common. A moving average is simply a mathematical equation over a set amount of candles as to what the average price is. By looking at the moving averages, you get the ability to see what the overall trend is. Now, as the market started to drift lower in this particular area here, although in hindsight you can certainly see that it is drifting lower, the reality is that it was very choppy during that time frame. So a lot of traders will use moving averages in order to kind of smooth all of that out. You can see that there is a squiggly line, and that is our 10 exponential moving average, in this case 10 candles, which happens to be 300 minutes. So you can see that the overall trend was down, and although it's easy to tell the candles after the fact, you have to keep in mind that when this is going on, it's much choppier looking. None of this information was available to you. So with the moving average crossover system, you need two moving averages because after all you need a crossover, and I will go ahead and plot a 20 moving average, and the 1020 is a very common moving average system, but there are other moving averages out there that you can experiment with. The idea is that you have a shorter term moving average, in this case 10 candles, and a longer term moving average, in this case 20. When momentum, the short-term momentum, crosses over the line of the longer-term momentum, that fires a trade in that particular direction. There are ways to smooth this out. For example, a lot of traders will wait a couple of candles just to make sure that the signal is reliable and gives it just a little bit more heft, if you will. As you can see, it does follow trends. So what I mean by this is, as we are in a very sideways market here, we fired off several times and the market really didn't go anywhere. But once you see the short-term moving average really start to drop, and you would have got this with a couple of candles of patience here, you see it starts to spread out from the 20 moving average. That shows that there's a real opportunity for momentum to pick up. So for example, right here you got the crossover, and then you started to see the two lines spread, and that's exactly what you want to see. You would have bought puts somewhere in this area, and you would have gotten out here where we crossed again. And again, we fired off the same type of signal. We went just above the line and then broke down a little bit. A few candles later, we're starting to see more space, and we did not cross really until we got to about here. So again, you have an indication of where the market's trying to go through all of the noise. A nice put buying opportunity. However, the spread as we broke down and then shot back up got very, very strong. You can see that without a doubt the momentum had changed short term. We got the spread again. It's another sign to get involved somewhere after this cross, or shortly afterwards. You could have bought your calls, and you can see you are still in the trade. Now we are in danger of crossing here. It's time to exit. So we have put, call, and the corresponding exits that allow you to at least see the direction of the market, and it keeps you on the right side of the overall trend. That is without a doubt one of the easiest ways to make money in the markets, because quite frankly there are pullbacks from time to time, but the reality is that the trend tends to run much longer.